This is Shawn Bragdon with BGA Insurance. I'm going to start this webinar. I want to thank you all for joining. If you like the presentation, give us a call. You can call me direct on the number on the screen or ask for one of the brokerage directors. We can provide the presentation and also the script. The topic is how to sell index universal life. There's actually 52 slides in this presentation. You're never actually going to go through all 52 of these slides with a retail customer, but typically any question or objection that your client might have on using an index UL product for a accumulation vehicle, the answer is typically embedded in this presentation. The first slide here is something I always go through. You know, if you're talking to a retail customer, you're going to say, Mr. Client, if you put $100,000 into a traditional equity investment, let's just call it a S&P 500 mutual fund, market goes up 10%, you're at 110,000. Year two, the market drops 15%, you're at 93.5, and then year three, the market rebounds up 5%, so you're at 98,000 and some change. That's a typical equity investment, one that you can lose principal on. By contrast, Mr. Client, if you put the same $100,000 into what's called an index universal life product, market goes up 10%, you're at 110,000. Your gains are locked in though. You're never going to lose those gains because when the market drops in year two, you do not drop with it. You are contractually guaranteed to get a zero when the market goes down. You wait for the market to rebound in year three and you start from your ending point. You're up 5%. And your total return in this example is 115.5, which is a 17.6 improvement over a traditional equity investment. Most retail customers get this, and you know, again, index UL, in my opinion, is far and away the most complicated product out there in the insurance space. And if your client doesn't understand it, they are less likely to buy. And I think this presentation will help you get that understanding. I love this slide. This is the growth of $100,000 from 2000 to March of 2020. In the red line, we have the S&P 500. If you recall, we had a 3-year bear market starting in 2000, went back up, had another bear market in 2008, and then it went back up. And then throughout this 20-year time frame, our 100,000 grew to 175,000 and some change. By contrast, if you put the same $100,000 into an index UL, this blue line, and you have a zero floor and a 12% cap, and what that means in English is your return is always going to be between 0 and 12%, depending on what the S&P 500 does in this example. So we get some zeros out of the gate, got some 12s along the way. Over this 19-plus year time frame, our 100,000 grew to 351,000. A vast improvement over the S&P 500 at 175,000. Oh, and by the way, we will open this up for questions at the end of the presentation. This is a nice piece. This is showing how an index strategy works in a horrible market. You might bump into some clients and prospects that are pessimistic about where the market is going in the future. If you had $1 million in the S&P 500 of the 1930s depression, over that entire decade, you never made a dime. By contrast, if you had $1 million in a product with a zero floor and a 12% cap, you did pretty well. You made almost $600,000 in what many people might say is the worst 10-year market we've had. So even in very poor markets, you can get some positive rates of return with an index UL product. This is a index strategy calculator that is available in our industry. It allows you to show the probability of achieving a particular rate of return on a particular index strategy. It's often referred to as a Monte Carlo analysis for an index strategy. In this example, we back tested an S&P 500 annual point-to-point index strategy. It has 11.5% cap. It has a 15% guaranteed bonus that kicks in year 11, and we back tested this back to 1980. I don't think you really need to back test anything prior to 1980 because, you know, markets really changed in the 1980s. That's when we had, you know, computers started hitting the world. The average rate of return in every 20-year rolling period since 1980 for this index strategy is 8.29%. But what this 50th percentile column is telling us is you're only going to get that return about half the time. So even if you could illustrate this number on an index UL product today, it would be, in my opinion, an aggressive rate of return to show your client. By contrast, if we look over here on the 100th percentile number, this index strategy did 6.8% or better in every rolling 20-year period since 1980. There are actually over 10,000 rolling 20-year periods in this calculation. You know, January 1, 1980, that's one 20-year period. January 2, 1980, another one. So the actual AG49 rate that you can illustrate on this particular product is 6.34%. You're not allowed to illustrate this product any higher than that. And so if we hit 6.8 100% of the time and you're illustrating it at 6.34, in essence, you're always going to be under-promising and over-delivering on a properly designed index UL product today. This just kind of shows how the market works. In 1980, the market went up 13.49. This product has an 11.5% cap, so you got 11.5. Year 2, the market dropped 8.76, so you get a 0. This product has that bonus that kicks in after year 11, so you're actually able to cap out at 13.23% on this particular index strategy. I think what's really compelling is typically the way markets work, you're either hitting your cap or you're getting a 0. There's not a lot of in between. And in fact, since over the last 40 years, the market is up 78% of the time. If you can eliminate those downsides, you can get some pretty spectacular returns on an index UL. This is a nice chart. If you invested $1,000 in a hypothetical investment that went up 10%, down 10% every year for 10 years in a traditional equity investment, you lose money. But if you have that floor like you do with an index UL, you make money. I'm sure many of you have seen this type of chart. On a traditional equity investment, something you can lose principal on. If the market drops 30%, you have to get a 43% return the following year just to be at break even. This is a great question to ask your client. Mr. Client, do you know the difference between an average return versus an actual return? Most clients will probably say, what are you talking about? Well, I'm your money manager. You give me $100,000. I have to cover off the ball year 1, 100% return. So you got 200 grand. Year 2, not so good, 50% loss. So you're back down to 100 grand. Year 3, a rebound year, 100% return. And then year 4, another 50% loss. So over this 4-year time frame, you started with 100,000, you ended with 100,000, you made no money. But as your money manager, I'm advertising the fact I've averaged my clients a 25% rate of return over the last 4 years. With a traditional equity investment, average returns can be very misleading. With an index UL product, due to the fact you're contractually guaranteed to never have a negative rate of return, you're getting actual returns. This is my elevator pitch for an index UL product. Mr. Client, would you be interested in a retirement product that has a historical rate of return north of 7%? You're contractually guaranteed to never have a negative rate of return. The money grows tax-free. You can pull it out tax-free at any time, and it's completely liquid. And what I mean by liquid, you put $30,000 into this thing, change your mind, you want all your money back tomorrow, next week, or next year, you can get it. Do you have any of that in your portfolio? What I just described to you is an index UL product with an early cash value rider that eliminates the surrender charge and makes it liquid. There are quite a few products out in the marketplace that offer that. And this next page is one of the most effective tools we have here at BGA Insurance to help you educate a client on why an index UL product can be a great supplement retirement plan. This report, you can plug in any traditional retirement product. It takes real world taxes and management fees. In this example, we have a taxable account, which is compliance speak for a no-load mutual fund with a management fee. Our tax-deferred account is a variable annuity with your typical fees included, and a TDRP, that stands for tax-deductible retirement plan, also a hypothetical 401k plan. So we have, in this example, a male age 45 who's putting in $30,000 a year for 20 years into all four of these retirement accounts. We're assuming 6.38% return on every one of these accounts, and we're taking real world taxes into account. This guy is at a 20% capital gains tax rate. We're assuming the equity fund has a 20% turnover. You can get as specific as you want on these hypothetical retirement accounts. Notice this client puts in $30,000. Our cash surrender value at the end of year one on this particular product is $30,000. So my elevator pitch rings true. This thing's 100% liquid. And of course, the design on a life insurance product is critical. We're solving for the minimum death benefit possible, not to create a modified endowment contract. You can't put any more premium into this policy without creating a MEC. So this client decides to start pulling out money at age 65. It's $110,576 out of each one of these retirement accounts. The variable annuity runs out of money first at age 73. The equity fund runs out of money at age 74. We go to the next page. Our 401k plan does the best. It runs out of money at age 76. And our life insurance, we're continuing to pull out this $110,000 tax-free throughout the rest of our life. And if you make it to age 99, your family still has $1.2 million in death benefit. We win. Our total retirement income stream that we pulled out of our life insurance is over $3.8 million. Our next best option was our 401k plan, which was just under $1.3 million. So this is truly an impressive comparison. This is a nice report. This is showing the return you have to get on a traditional retirement account to compete with an index UL at 6.38% in this example. Here's your taxable account. If you're getting north of 11% on your mutual funds, keep it. If not, the IUL will be a better decision. If you're getting north of 12% on your variable annuity, keep it. If not, the index UL would be a better decision. And if you're getting north of 9.6% on your 401k plan, keep it. But if not, the IUL would be a better decision. This is a more detailed report page on that 401k plan. If you're in a 35% tax bracket and you're putting $30,000 into a life insurance product after tax, you're actually going to have to make $46,154 pre-tax. Well, that's the amount of money that we are illustrating you are putting into this hypothetical 401k plan, $46,154 pre-tax, to make it a true, accurate comparison. And again, the same story rings true. Your 401k plan runs out of money at age 76. Often you might tell your client, hey, if your company is matching on your 401k plan, take advantage of that. But anything over and above that match, I've just proven to you, you'd be better off with an index UL. And it really boils down to the taxes. This guy's going to have to pull out $170,000 out of his 401k plan to net that $110,000, assuming a 35% tax rate. Now, why can't an index UL policy outperform most other retirement vehicles? Well, the taxes and management fees associated with a typical investment vehicle more than outweigh the cost of a properly designed index UL policy. This is the history of the average top tax rate in this country since the tax code started in 1913. Historically, we are in a low tax environment at 37%. The average top tax bracket in this country has actually been north of 57%. So, Mr. Client, with your traditional retirement accounts, you're in essence rolling the dice to see what tax bracket you're going to be in 10, 15, 20 years down the road. If you pay your taxes now, while we're in a low tax environment, put it into a life insurance policy, you're never going to pay tax on that money again. This is an interesting chart that shows 92% of the U.S. tax revenue is being used to pay for four things: Medicare, Medicaid, Social Security, and the interest on the U.S. debt. That's 92% of the tax revenue. That doesn't take into account defense spending, fixing the potholes in your neighborhood. In 2025, it's projected that 100% of the U.S. tax revenue is going to be used to pay for these four items. So what's going to happen? Well, in my opinion, they're going to increase taxes and reduce benefits. Probably, they're definitely going to do one or the other. I'm thinking they're going to do both. I mean, most people that I'm talking to would agree that tax rates are probably going to go up in the future. The previous chart doesn't even take into account the COVID-19 relief expenses. U.S. national debt exceeds 26 trillion now, and it's increased by 5.2 trillion over the past 3 years. And wouldn't it be a good idea to put some of your retirement money in a tax-free environment? There are only 3 products in this country you can enjoy completely tax-free. You got municipal bonds, which you might get lucky to get a 2% yield today, but keep in mind, muni bond income could require you to pay more tax on Social Security income. You got a Roth IRA option, but again, you can only put $6,000 a year into a Roth IRA, but if you make over $193,000, that's not even an option for you. And then, of course, cash value life insurance. There's no contribution limits. You can put in as much as you want into a cash value life insurance policy. A lot of clients I talk to don't realize what kind of tax rate they're in. This is a nice chart. You know, if you're making $300,000 a year, your effective federal and state tax rate is 29.52 for earned income, 30.97 for unearned income. So this is a nice cheat sheet. And then capital gains taxes for someone in California making $300,000, 28.1. Odds are you'll see those rates go up. Miracle of compound interest. Which job do you want? Job one's going to pay you $100,000 a day for 30 days, or you can take job two. It's $1 doubled every day for 30 days. You'd be surprised at how many people get this wrong. How much money are you going to have in 30 days? Well, job one's going to have $3 million, $100,000 a day for 30 days. Job two, $1 doubled every day for 30 days, you actually have north of $1 billion. That's certainly the miracle of compound interest. Now, let's add an additional factor into this. What if you had to pay a 30% tax on that $1 doubled every day? How much would you have left? Well, you'd have $8.1 million. You actually lose $1 billion due to taxes. Wouldn't it be a good idea to put something in a tax-free environment today? This is a typical objection that you might get or question. You know, I've been told that it doesn't make sense to use a life insurance policy for retirement purposes because the fees, loads, and charges are just too high. On virtually every index UL policy that you can run today in the industry, you can add a report that will show the fees, loads, and charges year by year on that specific illustration you ran for your client. That's what we have here on the right. Over here on the left, I have a hypothetical managed account for a 50-year-old guy putting in $100,000 a year for 15 years. We're assuming this thing is growing at 7% a year, and we're charging a 1.25% management fee. We are not deducting anything out of this hypothetical managed account. A managed account is actually a back-end loaded retirement account. Initially, your fees are very low. In this example, about $1,300 in year one. But as time goes on, as your account grows, that fee grows. And in this example, your client's retired at age 65. He's pulling out $148,000 a year. And this is the amount he can pull out every single year and zero out the account at age 100. So this client pulled out $5.3 million out of his equity fund, all subject to tax. And over his lifetime, he spent just over $1 million in management fees. By contrast, a index UL product is a front-end loaded retirement account. Your initial fee in this example is over $17,000 in year one, and it continues to be north of $17,000 for 8-9 years. But the fees start to go down, and our crossover point is year 16, where our managed account, you've spent $262,000 in fees. All the fees, loads, and charges in our life insurance, you've spent $245,000. And at age 65, you're pulling out $235,000 tax-free for the rest of your life. You end up pulling out $8.4 million throughout your life. And your total expenses that you've paid throughout your life is $946,000. So what this is telling me is the typical cost of a properly designed index UL is somewhere between 1 and 1.25%. And this is just a graphical representation of that chart we were just looking at. The managed accounts, a back-end loaded type of an account. The index UL is front-end loaded. Now, there are many different ways you can pull money out of an index UL policy. This chart is showing you historically, people are pulling out withdrawals out of a life insurance policy. That's a tax-free recovery of your cost basis. The money you put in, you can pull out tax-free. The way we beat the IRS when you pull the gains out of your policy is we call it a loan. And this is a loan you never have to repay back. Most of these products have what I call a standard loan, where the insurance company is going to charge you 5% on the loan. They're going to credit you 4% on the loan. So you have a 1% loan charge eating away some of the cash value in your policy. After year 10, most of these products have what I refer to as a preferred loan, where they charge you 5%, they credit you 5%. You got a zero spread, zero cost loan in this example. That's a pretty good deal. Well, what's unique to an index UL product is they also offer participating loans and variable loans. And this is something that, as far as I know, is unique in the industry. With a participating loan, let's assume your client puts a bunch of money into an index UL policy, and 5, 6, 7 years down the road, he wants to buy a new BMW. That BMW is going to cost him $70,000. BMW is willing to give him a loan, but it's going to charge him 6% a year. He thinks, hey, I think I can do better. So your client calls the insurance company, tells him he wants a $70,000 participating loan. Insurance company is going to charge him 5%, but the credit on that loan is whatever he achieved in his index strategy that year. So if he makes 8% on his index strategy, he's making a positive 3% on his BMW. When I was first exposed to this participating loan feature on an index UL, this is way back when I was working for an insurance company as a wholesaler, I thought the person was mistaken. How can you possibly make money on something you pulled out and spent? Well, it does work that way. It actually is an impressive benefit of an index UL product, and one of the reasons it illustrates just about anything out there for retirement. Now, of course, the downside on that type of participating loan is if the market tanks, you're going to have a negative 5% loan charge on a percentage of the money you have in your policy. And of course, a participating loan increases the risk to your client, but I often say risk compared to what? You know, I lost 35% of what was in my 401k plan in 2008. The worst case scenario with a participating loan, you're going to have a 5% loan charge on just a percentage of the money you have in there. And you also have the ability with most of these products to switch between a zero spread loan and a participating loan every year. This is the 20-year historical average loan arbitrage on a particular index UL product in our industry. The average arbitrage over the last 20 years is 2.61%. Unfortunately, with the new AG 49 rules starting towards the end of the year, the maximum arbitrage that you can illustrate is going to be 50 basis points. Currently, you can illustrate a 1% arbitrage. And in essence, this also compounds my previous comment that you're typically going to underpromise and overdeliver with any index UL products that are rolling out here. This is another concept that I call smooth sailing. If you're getting money under management, AUM, selling your clients an index UL policy can actually increase the amount of money you have under management. Here's an example of Bob. Bob's got $1 million in his IRA. He needs $100,000 for his lifestyle. He's in a 28% tax bracket, so he's going to have to pull out $138,000 to net his $100,000 for his lifestyle. If we go back to S&P 500 returns from 1988 through 2016 in this example, and Bob continues to pull money out of his IRA every year, Bob's going to run out of money when he's age 89. Now, had you met Bob 15 years ago when he was 50 years old, and you suggested Bob buys an index UL policy designed for retirement, he would have been much better off. And it's not like you would need to have him put a lot of money into that index UL. You might say, Bob, all I'm asking is you put $550 a month into an index UL for a supplement retirement plan. You need some death benefit to protect your family anyways. You'll be happy you have this alternative asset class. So now Bob has $1 million in his IRA again, but every time the market drops, instead of Bob pulling out all the money he needs for his lifestyle out of his IRA, he's going to tap into his index UL policy. And this allows his equity assets in his IRA to hopefully rebound the following year. In these years when he's beyond age 70, he's going to have to at least take out his RMDs, but the balance that he needs for his lifestyle, he's pulling out of his life insurance policy. And by using this smooth sailing approach, using an index UL policy strategically, Bob doesn't run out of money in his IRA at age 89. There's actually over $743,000 in that account that you're managing. So again, use an index UL to increase your assets under management. And this is just the index UL at $550 a month, and we're pulling money out of it strategically when the market tanks. This is a nice chart. What do these numbers represent? Are the big numbers good or are the small numbers good? Well, what this is showing us that if you pay an annual premium in an index UL product and just put that money in the S&P 500 annual point-to-point index strategy, you have a 92.3% probability of getting at least 1 return years 1 through 10. Simply by recommending your client pay monthly or dollar cost average into the same index strategy, you're reducing your odds of getting a 0 by 65%. The 0 down here at the bottom is the percentage of financial advisors that are actually explaining this to your clients. I mean, think about this. All you need to do is tell your client, pay monthly or dollar cost average, and you can dramatically reduce their probability of getting a 0 return on their index UL policy. Here's another report that shows that if we diversify between multiple different index strategies, that reduces your odds of getting a 0 if you pay an annual premium, and it dramatically reduces your odds of getting a 0 if you pay a monthly premium. And after year 5, in this particular study done by an insurance carrier, your odds of getting a 0 after year 5 are 0 if you pay monthly and diversify into multiple different index strategies. Historically, it's never happened. So what are we saying? Pay monthly, dollar cost average, diversify between multiple index strategies. You're going to do a better job for your client. This is an Allianz report that shows over the last 15 years, if you diversify between these 3 index strategies, your odds of getting a 0 in any one year was 4.72%, and your average return over that time frame was 7.93. Pretty compelling return. Here's another report that Allianz did showing the over 30,000 policies they've sold over the last 15 years, and the average return of all those policies was 6.98%. So this isn't a look back, hypothetical look back. They actually looked at the returns on all their policies that they sold, and they're averaging just under 7%. This is another carrier that actually publishes every single return that every premium you could have made into their index UL policy since 2007. Most insurance carriers, if you buy your policy, September 1, they're not actually buying the index option until September 15th. So they can easily track every single premium that could have gone into that policy. And that's what this report is showing, that you're actually getting some pretty nice returns: 6.15, 5.2, 10.67, 12.55. And since 2007, this particular product, if you paid monthly since 2007, your actual rate of return was 8.33% per year. And your arbitrage on your participating loan was 2.99%. So again, that's a pretty compelling arbitrage. And this is a nice example of why you want to pay monthly. Had you paid an annual premium in any of those months, you would have got a 0. If you paid monthly, you got a 4.16% return. Another carrier showing the actual returns on their policies. This shows in 2006 in the purple line, they illustrated the product at 8.08%. The green line is what it actually did. So it's actually outperforming 8.08%. So IUL sounds too good to be true. What's the catch? Typically, that's going to be, if you do your job correctly in educating your client on an index UL, that might be the question that you're going to get. Well, there is a catch to index UL. First off, you need to be somewhat healthy. You have to go through underwriting. If you are a table 8 smoker, this is probably not a good plan for you for retirement. The mortality costs are going to be too expensive. It's going to eat up all the cash value in your policy. The other risk that you have is the cap rate or the participation rate of an index strategy. One or the other is not guaranteed at the level that you're currently enjoying. If you have a product that has a 12% cap on an S&P 500 index strategy, the guaranteed cap might be only 3%. And if the insurance company decided to reduce that to the guaranteed minimum, your product is not going to perform. It's going to be horrible. But in the real world, this has never happened. These index UL products have been around for about 17 years. Throughout that time frame, there has not been a single insurance company that I'm aware of that has reduced their cap rates or participation rates to the guaranteed floors. And think about it. If an insurance company had some financial challenges and they were thinking about doing this to their policyholders, what would happen in the real world? First, they'd have to go to all 50 state insurance commissioners and convince them that they are so financially insolvent and their claims experience and their mortality assumptions were all wrong. They'd have to convince all 50 insurance commissioners to let them do what we're talking about. And what, again, would happen in the real world? Anyone that was healthy with that insurance company would simply do a tax-free 1035 exchange and pull that money from that company and put it to another one. Or they would just surrender the policy. The only people that financially insolvent company would be left with would be the sick people, the people that were uninsurable, and that would compound the financial challenges for this company. It just wouldn't really happen in the real world. In 2008, there were over 300 banks that went out of business, but not a single insurance company went belly up in 2008 when the world collapses. So if your client is still unsure or doesn't trust the insurance companies and thinks they're going to play games, you can always add an early cash value rider to one of these products that makes it liquid from day one. And in essence, they don't really have the risk of losing their money because it's all there. That is the presentation. Again, if you like it, think you can use some of this, give me a call, give one of the brokerage directors a call here, and we can send you a copy of this presentation. We even have it scripted out. We're also going to have this webinar posted on our website, and hopefully I can open this up for some questions now.
Yeah, there were two questions specifically. One asked by Greg, does BGA provide any software to compare index IUL to other investments?
We do. We actually have some software where, so the question was, do we have software that could be made available to show these types of comparisons of an index UL to alternative investment vehicles? Yes, we do. We can certainly make that available to you. There are actually, Insmark is the software we're typically using for that type of report. Some of the carriers we do business with actually provide that software to you at no cost. And again, we can illustrate that type of report on any product out there.
Another question that was asked is, if there's negative returns for a few years, will the client see their cash value go negative in those years?
Well, there's certainly, if you're going to get zeros in multiple years on your index strategy, you are certainly going to see your cash value go south rather than north, because there are monthly fees, loads, and charges in the policy that will be a drag on your cash surrender value. So yes, if there's multiple zeros, you're going to have a downside. Let's see, are there any other questions, Matt, that we have?
I didn't see any.
Hey, Shawn, I got a quick question for you. This is Robert.
Yeah.
On those earlier charts you were showing with the 175, where you go in with 100,000 and then the S&P takes you up to 175, whereas the index UL takes you up to 350. And then same question applies to a couple more charts. One was the Depression era slide, as well as the one where you're putting in 10%, or rather the market's taking you up 10%, taking you down percent. Those, are they taking into account the expenses associated with a policy, or is it just purely straight in 100,000?
Pure math on an upswing and a downswing. It does not take the fees, loads, and charges into account on the life insurance policy, nor does it take into account the management fee on a typical equity fund or the taxes associated with an equity fund.
Okay, fair enough. Thanks.
Mm-hmm.
Another question that was asked is dealing with COVID, and to paraphrase, what are going to be the long-term effects from COVID? I'm assuming what the person meant was as it relates to fees on life insurance policies, and how are the life insurance carriers handling this?
Well, certainly I think due to COVID and the money that has been spent by the government in the relief packages, I think the only thing that could possibly happen in the future would be an increase in tax rates, which in my opinion would make this product even more attractive. As far as COVID and the volatility in the marketplace, these insurance carriers, they buy options for these index strategies. The more volatile the stock market is, the pricier these options are. And so what we've seen over the last 6 months or so is many of the cap rates and participation rates on these index strategies have come down. Another big rule is coming down the pipeline in the fourth quarter. There's this new rule called AG 49, and the AG 49A rule is going to limit the illustrative assumptions that you can run on an index UL product with a multiplier. There's a lot of products out there that it looks like it's crediting at 6.5%, but due to the multipliers embedded in the product, it might actually be illustrating 8.5% internally on the illustration, which makes for a pretty attractive proposal. Those types of illustrations starting, I've been told, mid-December will not be available. The products will still have these multipliers, but you just can't illustrate them. So going forward, once this rule changes, you're probably going to see income distributions from an index UL illustration drop somewhere between 10 to 15%, even though the product would likely achieve those returns. And so again, Going forward, most likely you're going to underpromise and overdeliver on any index UL product that you're illustrating. The other thing with this new AG 49 rule is there's only going to be a 50 basis point arbitrage on that participating loan, which is ultra conservative. I showed previously on this slide that historically you're getting north of a 2% arbitrage on a participating loan. Let's see. Here's another question from Matthew asking about dollar cost averaging and a monthly premium. Most carriers do offer dollar cost averaging, and in essence, you're just going to put your annual premium into the fixed bucket of the insurance carrier, which might be yielding somewhere between 3 to 4% today, and they will simply move that money into the index strategies on a monthly basis. So you can still collect an annual premium, get paid all your commissions up front, and they just dollar cost average into the account. Let's see. I'm not sure if I understand that question. Are there any viable second to die options in the index space? There used to be. I mean, there used to be a handful of accumulation, survivorship index UL products in the industry. They have all been pulled out of the marketplace for the most part. The index second to die products that I'm aware of that are in the industry are not designed for accumulation purposes. They're designed for low cost death benefit protection. I think you got Hancock, Zurich, Pru, I think are about the only carriers that come to mind that have an index second to die product, and none of those products are designed for accumulation purposes. Hopefully that'll change. You know, hopefully carriers, after this new AG 49A rule rolls out, that they'll reprice some accumulation second to die products, because that could give you some mortality cost advantages. I think that's all the questions we have. Thanks again for attending. Again, if you haven't spoken to anyone here at BGA Insurance, give us a shot. Give us a call. You can see us online, bgainsurance.com. If you'd like a copy of this presentation, give us a call and we'd be more than happy to send you out a copy. And thanks for attending.